Hello everyone, I am Akshay Sharma, a research analyst with Abakkus Asset Managers, and today I'll be taking you through our views on the listed hotel space in India. Let's start with the segment map and who are the players. When we talk about listed hotel companies in India, they can broadly be classified into two categories: brand owners and asset owners. Firstly, asset owners are the companies that own and operate the hotels, whereas brand owners are the companies that manage to franchise hotel brands without necessarily owning the underlying asset. Further, the hotel industry is segmented into four categories based on quality. First comes the luxury. This is the ultra premium properties in iconic location and iconic brands like we have the Leela, Taj, ITC Grand, Hyatt Regencies. These hotels have ARR above 15,000 per night to up to 30,000 per night. Second comes the upper upscale segment, where these are the premium business hotels such as Marriott, Hyatt, Westin's, where the ARRs are above 9,000 and up to 15,000 range. Third comes the upscale and the mid-scale segment. These are comfortable and widely accessible hotels like Courtyard, Ibis, Ginger and Novotel brands. Lastly, in the economy segment, we have the budget hotels and the aggregator-driven models such as OYO. Before evaluating a hotel company, we focus on the following key levers. First, coming to the revenue lever. So, the two important things we look at is the ARR and occupancy. The average room rent reflects the pricing power of that hotel in the micro market which it is present in, and occupancy reflects the demand of that segment in the particular area. Both the product of ARR and occupancy is the RevPAR, which is revenue per available room. So we look at the RevPAR CAGR, the key addition CAGR, which we look at the pipeline of the hotels upcoming in the next 2 to 4 years, and the contribution of non-room revenues in the revenue growth. The second lever is profitability and scale. So for that, we look at the segment exposure. What percentage of revenue is coming from the luxury segment and what percentage is coming from upscale to mid-scale segment. This is important because for a, let's say, economy or a mid-scale segment which is doing an ARR of 3,000 versus a luxury segment which is doing an ARR of 20,000, a 10% ARR growth significantly changes the scalability of the company. And also we look at owned and managed mix. This indicates the balance sheet strength, the growth potential and the ROCE dynamics of the hotel. Third lever is the stability. For this, we look at the presence across cities in India, the international footprint and the share of non-hospitality revenue streams. On the valuation side, we use relative valuation and give a multiple on EV to EBITDA basis. Now let us look at the Indian business scenario. In India, unlike developed markets such as US, asset ownership continues to dominate value creation. This is primarily because a branded hotel penetration is still relatively low and the land appreciation is significant over time. This appreciation does not get reflected in the P&L but is a critical contributor to overall returns and leads to gradual improvement in ROCE over the long term of the asset beyond 15 years. On the other hand, asset-light models, they offer a stronger balance sheet, faster growth rates and higher return ratios because of their franchise-driven revenue sharing model. In recent years, most Indian hotel companies have adopted a balanced approach between owned and managed hotels, creating a diverse growth and ROCE profiles for the investors. This balanced strategy has also strengthened balance sheets across the sector, enabling better pricing power and a continued ARR growth even during the short-term demand slowdowns. As you have seen recently, where despite occupancy decline due to Middle East conflicts, the flight disruptions and the other various issues, the ARR still grew at high single digits to low double digits in certain segments. Also, a healthy balance sheet allows companies to pursue both organic and inorganic growth opportunities without relying excessively on debt. We have a strong positive view on the upper upscale and the luxury segment of the hotel sector, driven by a combination of favorable structural demand, constrained supply and improving balance sheets. To explain this, I will take you through the demand and supply drivers. From an industry perspective, active supply is expected to grow at a 7.5% CAGR over 25 to 30 versus the demand is expected to grow at a faster rate of 10.4% CAGR over the same period. The supply growth is further broad-based and across segments and geographies. 2/3 of this demand is coming from the non-metros, whereas only 20% of the demand is coming from the metro cities. The luxury segment is best placed because it has relatively lower supply growth of only 5.6% CAGR. The reasons being high capex per key, expensive land acquisitions in the tier 1 cities, limited availability of prime land parcels, and regulatory challenges. These constraints benefit players with an existing strong presence in these cities, allowing them to command premium ARRs. On the demand side, hotel demand in India comes from 3 key segments: domestic households, corporate MICE and events segment, and GCCs and international tourism. On the domestic demand, we are seeing a rising disposable income due to policy support from government like income tax rationalization and GST reforms. The growing aspirational middle class, which is expected to rise from 31% in FY24 to 47% by FY31, their spending pattern is also seeing a shift towards premiumization, with higher spending on dining, events and experiences. And at the top end of the consumers, we have the HNI population in India, which is growing at 5.6% in 2024. This was highest among our peer countries in the APEC region. This supports demand for luxury and the upper upscale properties. India is also seeing a strong wealth creation at the top end of the consumers. Second is the corporate demand. This has also recovered strongly post-COVID, supported by improved earnings growth. For example, you can take Nifty earnings growth as a good proxy for the same, which shows significant growth from the last decade. The MICE activities has been a key growth driver. This is also expected to grow at 13% CAGR. This segment is particularly valuable because it not only drives the room revenue but also supports the overall total RevPAR through F&B revenue and banquet income. Recently constructed convention centers, Yashobhoomi in Delhi and Geo Convention in cities like Mumbai and New Delhi and Jaipur, along with other sports and entertainment events, will further support demand. Lastly, for the international demand, the number of GCCs in India has increased from 1430 in FY19 to 2000 by December 25, and this is expected to reach 2500 in the next 4 years. This trend is a strong driver of international corporate travel. And just to give you a context of global space in this segment, US, UK, the ADRs are in the range of $170 to $190 per room, whereas India ADRs are 95 to 100, which leaves us with a significant headroom for growth. The global business hubs command even higher ADRs, with New York and London priced at $330 and $310 per room, and Singapore and Hong Kong priced at $285 and $245 per day per room. This is despite these cities having a much higher densities of hotel supply, indicating a long-term pricing potential and a structural story for branded hotels in India. Thank you.